they were sideswiped by the global crisis, so they only have 3 years to get there. But I think the fiscal union and the political union have to be on the back burner. There are much more immediate problems for Europe to face. So that's a pretty dire prognosis for the euro. When I go to Europe, I like to tell them I'm the best American friend you have. I believe in the euro. I think holding the euro together will be immensely expensive, but breaking it up will be even more expensive. But you can tell from the last 20 minutes that I've grown much more pessimistic. So I can try to end on a slightly happier note by talking about the third candidate here, which is China, but I warn you, it won't be entirely happy. Chinese policymakers are intent on making their currency, the renminbi or the yuan, a true international currency, to encourage its use for international trade, international financial transactions, and 10 years from now or so to elevate it to the point where it is a consequential reserve currency as well. I think they understand that it's an advantage to the United States that U.S. banks and firms can do international business in dollars. It increases their competitiveness, it reduces their costs, it's convenient, and they would like Chinese firms to enjoy the same convenience. Chinese leaders think that Asia is moving toward a single currency as well, but they think it's going to be their currency, the renminbi. They have a typically well-formulated Chinese strategy for internationalizing their currency, one small step at a time. They're crossing the stream by feeling the pebbles under the water. They're progressively encouraging use of the renminbi in Chinese import and export transactions. They are allowing it increasingly now to be used in financial transactions. So the most recent announcement was they were creating a financial free trade zone in Shenzhen where there would be no capital controls. And if you were a Brazilian bank and you wanted to trade renminbi or invest in the mainland city of Shenzhen, you could do so without restrictions. There will be restrictions, and we'll see how porous they become between Shenzhen and the rest of the mainland, but it's another step in the direction of opening the Chinese capital account. They're going slowly but surely, but they're going in that direction, and the last stage will be to encourage use of the renminbi as a reserve currency. The Chilean Sovereign Wealth Fund holds Chinese government bonds. The Central Bank of Malaysia holds them as reserves, and I think the Central Bank of Nigeria, because of petroleum refining relations between the two countries, holds them as well. China has a long road ahead of it in order to accomplish this. Its financial markets are small. Its financial markets lack liquidity. Bank deposits are not an attractive form in which to hold central bank reserves, for example, because these are not normal commercial banks. They're still controlled by the government. Liberalization of the capital account may not continue if China experiences large outflows and a crash sometime in the future. There are doubts about the security of foreign investments. All reserve currencies in the past have been currencies issued by democracies in which foreigners feel secure about investing. Is that a problem for China as it seeks to internationalize its currency? I leave it as a question. And then there's the growth slowdown in China, which has two components. One is that China is aging. Its labor force has stopped growing. The share of the population that is elderly is rising. Its savings rate is poised to go down. Its growth rate will decelerate secularly over time. So the working paper I show you here, we wrote a couple of years ago. Boy, did we get criticism from the Chinese for saying your growth rate is poised to slow. Now that it's slowing, we get less criticism. And in the short run, I think there are questions about whether China. Growth in China slowed to 7.6%, down from the double digits, recall, in 2012 quarter two. The housing market continues to weaken. New housing starts continue to fall. Export growth is lower because the global economy is doing poorly. And I worry that the official numbers, the light blue line at the top, which show a 7.6% growth rate in the most recent quarter, are questionable. Electricity consumption is falling in China. Are steel mills and aluminum smelting factories learning suddenly how to use less electricity? Or are the official growth numbers smooth relative to the underlying reality? The fact that producer prices have been going down is another reason to worry that things are softening in China now more than the official numbers suggest. I'm less worried about China than some people and less worried about China than I am about the US and Europe, because China is a controlled economy. China is a planned economy, and the planners can tell the banks to lend, they can tell the state-owned enterprises to spend, and they can tell governments to invest in more infrastructure projects, and that's what they're doing. So the good news is that they can bring the Chinese economy in for a soft landing. The bad news is that the process of rebalancing, where bank lending is brought under control, there's rebalancing away from investment toward consumption, and dubious investment public infrastructure projects are no longer built. That rebalancing process is now going to be put on hold, and I think what that means is more problems will build up for the future. So where does that leave me? It leaves me relatively sanguine about the dollar. The US economy has big problems, but Europe's are much bigger. It's hard to bet on the euro in this environment, and the only perplexing observation is that the euro is still as strong against the dollar as it is. And I think if China continues to slow, one of the levers that Chinese policymakers will pull is to halt all appreciation of the renminbi against the dollar. They already have, because they want to keep exports going to keep the Chinese economy going. So to conclude, let me ask this final question. What does it imply for the world? What does it imply for Brazil if Europe fails to draw a line under its crisis? The euro does not become an attractive source of international liquidity. China is slow to internationalize the renminbi and encounters bumps on the road. The renminbi is not an attractive source of international liquidity. And worst of all, maybe there's a crisis of confidence in the US, and the dollar is no longer regarded as a safe haven and an attractive source of international liquidity. The answer is there is no adequate source of international liquidity. Switzerland cannot be an adequate source of international liquidity to the entire world. Australia cannot be an adequate source of safe assets to the entire world. They are,
maybe Argentina, for instance.
well, maybe Brazil at some point. So this is a world starved of liquidity. This is the world we saw in the 1930s, when trade credit for cross-border transactions becomes hard to obtain. Cross-border lending and borrowing become more costly and difficult to execute. Central banks do not have an attractive form in which to hold reserves, so they deal with financial volatility in other ways by tightening their capital controls. That's a scenario in which globalization as we know it is placed at risk, and that's what we saw in the 1930s when trade collapsed. This is the famous cobweb diagram from the League of Nations in the 1930s showing you the collapse of trade. International lending collapsed. The first era of globalization collapsed, and the Great Depression, a deflationary crisis, occurred because of a global shortage of liquidity, the worry being that it could happen again. Who could run to the rescue? I think the answer in the short run is no, is no one. But if we manage to skate over the next 10 or 20 years, I do think Brazil could be a meaningful supplier of global liquidity along with the United States and Europe and China. And I think India, as a country with favorable demographics like Brazil, as a country with reasonably well-regulated banks and financial markets like Brazil, and with considerable scope for growing, already a large economy population-wise like Brazil, could be a meaningful, at least subsidiary source of global liquidity. So I think the story potentially is a very happy one. 10 or 20 years from now, I hope that everyone in this room lives so long.